Hi, my name's Steve Beck. I'm a chartered financial analyst and a certified management accountant and also a hedge fund manager. And in this session, we're going to go into the market multiples and look at comparable companies to try and get an understanding of values and how we can use those to determine whether the share or the company we're looking at is over or undervalued. Market multiples, really what we do here is we go out into the market and we're trying to find some comparables. So for example, let's say we're looking at IBM, we're going to look at a company similar to IBM, maybe we'll look at a Hewlett-Packard or maybe even an Intel in a way, or maybe we'll look at both of those two to try and get an understanding of IBM and how it relates to companies out in the market. So the first thing we're looking at is in comparables is we take in multiples and we're looking at them relative to either companies or indexes that we've determined drive the value of our company. And then what we're going to do is we're going to weight those forecast or those comparable multiples, and we're going to try to depict, based on those multiples, whether our company is over or undervalued. So a very quick example, if our price to earnings ratio for, let's say, IBM is 10 and everyone else in the industry, or all the comparables that we're looking at have price to earnings ratios of 15, we're going to wonder why IBM's ratio is 50% or 30% below the rest of the industry and the rest of its competitors. And we're going to use those multiples or the difference in those multiples to try and pinpoint differences. And if we can't find any problems or any reasons why that multiple is so undervalued, we'd potentially put out a buy recommendation on that stock. So that really sums up what we're going to look at in the comparable approach. And we're going to look at different ratios to try and depict how to determine whether this company is over or undervalued and why. So let me give you a little bit more of an in-depth overview of the topic before we go further. The first thing we're going to look at is comparables. And this is really comparing the unit of value to multiples of companies or benchmarks, as I said, that are similar to the underlying company to determine the over or under value. And this is the comparables is based on the law of price, that in other words, you're not going to pay more for one product than an identical product that's also available in the market. So for example, you have two watches, one tells the time just as well as the other one, unless there's some specific features on the second watch that the first one doesn't have, the comparable analysis would say that they should both be priced the same. So what we can do is we can use this with other companies that are comparable in nature to ourselves, or we can use it as an index that's comparable to our company in the case, for example, of IBM. Obviously, we can use some kind of forecast fundamental approach, and we can relate this to earnings per share or some other projected fundamental cash flow. And here we're using a discounted cash flow analysis, and we calculate the present value of cash flows and divide this by the forecasted earnings per share. And we can obviously use this in conjunction with forecasts on our comparable companies and try to determine why differences exist and if those differences are sustainable. And we also can use this if no companies exist and just forecast it for ourselves and then try and determine what the value of the company is on a standalone basis, of course. But in this session, we're going to be looking specifically at market multiples. Moving on to the justified price multiple, or the intrinsic value of the company. It's really estimating the fair value of the company and determining by comparing our estimate of fair value to what the fair value according to the market is. Once we've got the two approaches, i.e. the fair value as depicted by a comparable or by the market multiples versus our justified or intrinsic value calculation, we can then also see whether we think the company is over or undervalued. And really that brings us down to the bottom topic, and that's what this is all about. We're trying to get a good feel for whether our company is over or undervalued, and we're going to base this on comparables. We're going to forecast our dividend discount model or a DCF model. We're going to try and calculate a justified value, compare it to what we found in the market under the comparables or under an index, and use that as an estimate of whether the company we're looking at is over or undervalued. Now, when we're looking in the market, we're not necessarily just going to use one multiple or one ratio. We're going to look at a number of ratios. What you're going to try to do as an analyst is really find out which ratios are most pertinent or most representative of the company you're looking at. So what we can do is we can look at a price to earnings ratio, we can look at an EBITDA ratio, we can look at a cash flow ratio, price to book value ratio. And these are some of the ratios we're going to go into in depth. But the thing to remember is, as an analyst, what you're going to do is you're going to really get just a slew of different ratios. You're going to compare those ratios to what you see in the market. And what you'll end up more than likely doing is throwing out some of the outliers. For example, your company might have a price to book value of, let's say, 1, and everyone else in the industry is at 10. And there might be some specific reasons why there's that big difference. And so you might just not use that ratio because it's just not comparable at all. And you might concentrate on like a price to sales ratio when the ratios are a little bit closer. However, by targeting these huge differences that are available or that you see when you're looking at your comps is really going to assist the analyst in depicting where the differences are in the companies, whether that difference is sustainable, and therefore whether the stock you're looking at or the company you're looking at is a buy or a sell. So the first ratio we're going to look at in detail is price to earnings. Now, you can have a trailing price to earnings or a forward price to earnings. The initial one we're going to look at here is a trailing price to earnings. And really one of the main reasons for using a price to earnings ratio is really, it's widely used, and it's really, because earnings are typically the driver for all appreciation in stock price, it's quite a good one to look at, and everybody seems to at least start with a price to earnings ratio. The thing to remember though with price to earnings is specifically the earnings portion. You're right at the bottom of the income statement here. You're at the earnings level. So managements can really manipulate this number. There's a lot of different things you can do on the way down the income statement. And in recent times, we've certainly seen a slew of different or innovative methods of messing around with the accounting systems. So once you get down to the bottom line, earnings is a very difficult number to really place any credence to. The next thing, of course, is it's very volatile. It goes up and down, and in certain cases it can be negative, or most of the time it seems these days it's negative. And so once it's a negative earnings, you really can't have a ratio there because it doesn't make any sense. So for those reasons, oftentimes a price to earnings ratio is really not a good number to use, but we'll stick with it for right now, just mainly because it is a very widely used number, and companies that do have earnings, it's real quick, easy. This analysis can be done in literally 5 minutes, and you've got a good comparable or a number that you can use to compare against other companies. So what we're going to do is, as I mentioned before, we're going to look at a trailing price to earnings first, then we're going to look at the forward price to earnings. One thing as an analyst you can do is definitely make some basic adjustments to the earnings number. For example, you can add back some of the non-cash items. You can also add back some of the one-off items like non-recurring items, things of that nature. And what you're also going to want to do is when you look at your companies or the comparable companies, you're going to want to try to make sure that at least there's a relative consistency between their accounting methodology and therefore their earnings number in relationship to yours. So whatever adjustments you make to your numbers, you might want to go back and see if you might need to make those adjustments to other companies, or in certain cases you might not even need to adjust yours, but then you'll probably have to go back and adjust the comparable numbers. But the point I'm trying to make here is you need to make sure that your earnings numbers are consistent before you can really get a good understanding of how comparable or what the differences are in your price to earnings ratios. The first thing we're going to look at, as I mentioned before, is non-recurring items. These are transitory in nature. And where we find these is in our footnotes and in the management's discussion. They typically won't, we're going to have to go and do a little bit of digging to find these items. And what we're going to do is any gain or loss on sales, asset write-downs, provisions, etc., changes in accounting estimates, those types of things are the non-recurring items, and those we're going to reverse out and add back to the earnings in the case of expenses and remove in the case of income. The next thing to remember is that things are cyclical in nature. So you've got the Molodowsky effect, which is really during a downturn, price to earnings ratios sometimes can spike upwards, mainly because earnings drop, but the share prices don't drop as much, so you've suddenly got a high price to earnings ratio. This is cyclical in nature because then you have a high growth period, and the next thing, your price to earnings ratio goes back to normal and then sometimes even drops. So you have to remember that, and you need to require or normalize your earnings per share to take that into effect.